Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Friday, February 29th. Apparel retailer Gap reported its fourth quarter results after Thursday's close. The most important aspect of the report is that it filled a credibility gap, meaning the results validated the view that Gap is on the right path with its turnaround effort. Net earnings rose 21% to $265 million, or 35 cents per share, which was in line with the consensus estimate and up from 27 cents per share last year. Net sales declined 5% to $4.66 billion, and comparable store sales decreased 3% compared with a 7% decrease on a like basis in the fourth quarter of the prior year. Cost reduction initiatives were the key ingredient for the earnings growth, while share buyback activity helped drive the increase in earnings per share. Importantly, Gap expanded its gross margin, showing that it is doing a better job of managing its inventory so that it doesn't have to sell as much merchandise at fire sale prices. Gap indicated in its report that inventory per square foot decreased 15% on a year-over-year basis at the end of the fourth quarter, and that it expects a low-teen percentage decline year-over-year at the end of the first quarter. For the year, Gap's gross margin rate was 36.1%, up 60 basis points from fiscal 2006, while its operating margin rate increased by a similar amount to 8.3%. Gap is forecasting operating margins to be between 8.5% and 9.5% of sales in fiscal 2008. In a separate announcement, Gap said its board of directors authorized an additional $1 billion share repurchase program and that it intends to increase its annual dividend from 32 cents per share in fiscal 2007 to 34 cents per share for fiscal 2008. Gap's report admittedly is not stellar. The earnings growth is being driven by cost reductions as opposed to sales growth, but that is typically the case in turnaround situations. Gap, of course, has been stuck in a turnaround mode for some time now, yet with inventories under control, the rate of new store growth being slowed, and a better focus on its target audience, the seeds have been planted for an improved performance from the top line down to the bottom line. Accordingly, we continue to build a position in the stock. I'm Pat O'Hare for Briefing.com. Thanks for listening.